Did you know that Swiss franc or Switzerland was the last country to break the gold standard in 1999? The Bretton Woods system effectively came to an end in early 1970s when Richard Nixon, president, announced that the US would no longer exchange gold for US currency. So it took another 30 years for Switzerland to decouple their national currency from gold and become a fiat currency. Good evening guys and welcome back. Today is the 6th of March, Saturday, and I'm here to talk about three things. The first one is the usual recap of the gold USD spot market, where I try to explain certain events and moves, why did they happen and how did they happen, and I also give you a full breakdown about the trades I took this week. A second is the weekly forecast, where I try to analyze the market from the technical as well as the fundamental perspective and give you some tips, ideas about the coming days, weeks, and how to trade, what things to look out for. And the third one is I have a little surprise for you, so if you're interested, make sure you watch the video till the very end. Previously on gold. So let's start the analysis by recapping what happened this week on the gold USD spot market. In the last video I explained and talked about this consolidation area and the breakout candle and how I expected the price to reverse this bearish market trend or market direction from the 1717 area, bounce back and reach the 1800s again and hopefully break through this descending trend line. But as you can see, the price had different ideas and just melted and invalidated my setup. So let's go down to a smaller time frame and analyze further. You can see that my entry point was somewhere here on the 1717 area. I marked with the dashed line. The stop loss was around 30 pips, so I had two trades here, and you can see that the price didn't even reach the previous high. It just made a new lower high instantly and then melted again, invalidating my setup. And don't tell it to anyone, but I had two losing trades. Yes, I lost 60 pips, which I know it's unbelievable, but this is trading, and you know, some days or some weeks you have wins, on other days you have losses. But what separates you from the losers and the suckers is proper risk management, because if you look at the top left corner of the chart, with these two losing trades I had only 60 pips loss, which is not a big deal, because if you look back all the previous videos in February, you can see that overall we made, or I made about almost 5,000 pips on gold. So 60 pips loss is nothing, and you know, losing trades should not affect your overall profitability, because losing is part of the game. So without proper risk management, do not attempt to trade. And that's why I always advise to any students or anyone I speak to is never risk anything more than 2 to 3% on any trades, because you can never be 100% sure which direction the market will go. You can have some educated guesses, but I guarantee that, you know, if there's a central bank or hedge fund purchase, it can just cross all your plans and break a stop loss. So going back to the chart, you can see that the price came back and retested the 1710 area, spiked back to 1700, which is an extremely strong psychological number, guys. So keep your eye out, because we reached an important level at the 1700s. And later that week, after these two losing trades, I didn't trade because I wasn't sure what's happening with gold. Obviously the market is still bearish, but because we reached the 1700 area, which is a fun, you know, it's a crucial point, which could be a potential reversal point. But I had two losing trades trying to guess the reversal, and I was out from the game because, you know, I had two losing trades. I just stopped trading and focused on something else. If you go to the website, you can see that there's a really nice new design of the website. So I had some time finally, because I stopped trading for the week, I had some time to sit down with my designer and redesign the whole website. So we have some fancy pictures. I'm also planning to update the whole course material in the coming months. And if you click on the purchase tab, you have 30% discount until tomorrow evening or Sunday evening, so the 7th of March. So currently, at the time of making this video, you have 1 day and 9 hours to enjoy the 30% discount on all of the courses, so the basic, pro and premium. You can see all the details about the plans, what's included. But if you have any questions or any doubts, make sure you hit the contact button and send me a direct Telegram message, or send an email if you have any questions. But don't forget, guys, this month there won't be any more sales soon, so you have 1 day, 9 hours and 45 minutes to enjoy. Let's go back to the chart now. Okay, so Jay Powell had a speech on 4th of March about inflation expectation, and as soon as he was very dovish, so the price just melted. Sorry, very hawkish, so the price just melted, because I will talk about the inflation expectation and how Jay Powell was screwed over by Joe Biden. But the most important thing is that the price melted here, came down to 1680, 1690 area, and currently it closed just above the 1700 level. And let's look at the technicals and the fundamentals and what can we forecast for next week or the coming weeks. Well, starting with the technical analysis, if we go to the weekly time frame, let's see what we have. So we're still above the consolidation area level. If the price breaks below the 1678 level and the level of the bottom of the consolidation area, you can expect some sharp moves to the downside, and who knows where it's going to stop. So what you have to watch out or look for is, I know it's the weekly time frame, but if you go down to a smaller time frame, if the 1677 level breaks, you have to wait for the break, make sure the candle close below this level, and then wait for a retest on a smaller time frame, and then you can enter into short position. And obviously the first take profit level will be the 1500. I don't think it's going to go down below 1500, but who knows on the gold these days. So this is the short scenario, but because we are still in this consolidation area, if you look left, the price is really unpredictable, and also there are key fundamental things which I'm going to talk in a few minutes. So if you go down to a smaller time frame, we can draw our first trend line, this one. So if this trend line breaks and the price starts to make the usual market structure, so bullish market structure, you can jump on and we can expect a trend reversal. You see that this here could be a nice potential inverse head and shoulder. So as in the previous video, as I said, I am expecting, or I'm waiting for a bullish market structure on gold, and until this doesn't happen, I'm not going to enter into any trades. Well, actually I did open a trade at the bottom, but only with a small lot, because I had 2 losing trades here trying to guess the reversal, and catching falling knives is extremely dangerous. I got burned, I lost 60 pips, so I only opened a small lot size at the 1690 or something area, and I look for, or I wait for a reversal pattern, for example an inverse head and shoulders. So the first thing they have to break is this descending trend line. The price needs to close, or the candle needs to close above this trend line and start to form higher highs and higher lows. So simple as that, guys. Make sure you watch out for double bottoms or inverse head and shoulders, and that's the only one thing I'm waiting on the technical side now. And I'm not going to enter into any short trade, because we marked the 1676 area, which was the bottom of the consolidation area. So within this area, within this range, anything can happen, but it's more likely that the price is going to reverse soon, because I am still bullish on gold. And just to repeat what I said, I'm waiting for this trend line to break and the market to form high highs and high lows. And hopefully, if this could be a nice inverse head and shoulder if the price give this pattern. Until this doesn't happen, I'm not trading gold. I'm just watching and waiting, because if I don't trade, I don't lose any money, which is better than losing any money. So we talked about the technical side of the gold market, but now let's look at the fundamentals. It's important to spend a few minutes and talk about economics and fundamental analysis, because trading on any financial markets this week based on pure technical analysis was really difficult, and that's for one simple reason, is that the fundamentals are now outweigh the technical analysis in trading. So looking at the US economy, inflation slowly starts to creep back into the equation, which affects everything. So when inflation goes up, the stock market will go down, because the inflation will eat into the profit of the US companies, so discounting future cash flow. Now, let's go back to 2020 and look at the Federal Reserve and Jay Powell. So Jay Powell and the Fed announced at the start of COVID that they are going to guarantee the ultra easy money for years to come, because the situation was so bad that they had to create stability and promise to investors that they will have access to cheap finance. But then Joe Biden came into the equation with his $1.9 trillion stimulus package, which is one of the biggest we ever saw on the market. Now you have to understand that the Fed is independent from the White House, meaning that they have two mandates. The first one is keeping inflation below 2% and creating financial stability in the financial markets, so making sure that the businesses can plan ahead and there is stability on the market. So right now we have conflict of interest. On one hand, Joe Biden wants to kickstart the economy with a massive $1.9 trillion stimulus package. On the other hand, Jay Powell trying to stir the economy with monetary policy and making sure that the economy will not overheat and will not blow up. On this chart you can see that the money supply circulating in the US economy is already at all-time high. This is due to the aggressive monetary and fiscal response to the coronavirus crisis in the US. If you look left on the chart, you can see that this expansionary monetary policy and fiscal stimulus is nothing new, or not new, because throughout history the Fed and the government tried to kickstart the economy by reducing the interest rate and increasing the fiscal spending in history. But the problem here, and what's really scary, is the pace of how they increased the money supply back in 2020 from March to September or something, and now adding $1.9 trillion to this spike and this already at all-time high money supply is not going to help anyone, especially Jay Powell, who's under great pressure to stir the economy out of this mess. One of the Fed's and Jay Powell's tool to control inflation and the money supply is through the contractionary monetary policy, which is the opposite of the expansionary. The goal of the contractionary policy is to reduce the money supply within the economy by decreasing the government bond prices and increasing the interest rate. This helps to reduce the spending, because if there's less money in the economy, those who have money want to save it and keep it instead of spending it. It also means there's less credit available, which can reduce spending. Now the problem here is that the US stock market, all the big companies, all the big fintech companies had access to cheap financing in the past decade. So since 2008 actually they had access to really, really low interest rate loans. And increasing the interest rate will affect their profitability, because if they have to pay greater interest rate on the loans, the profitability of the company will decrease. And if investors get less return from the stocks, they're going to pull out the money and put somewhere else where they get higher yields, for example the government bond market. So you see how the private and the public sector is in constant battle. And the stock market had a good run in the past 12 years, but I think it's going to change soon. And looking at the US yield curve, which represents the short and the long term of the government yields, and also represents the inflation expectation of investors, you can see that the yield curve is currently steepening, which means that investors expecting increased inflation in the long term. You can see that the right hand side is higher than the left hand side, so it's steeper. And this chart doesn't look good. And you can tell that the market participants or investors already started pricing in inflation in the longer term, and I'm talking about 10 to 20 years. So overall, right now you can understand why I said that the fundamentals are currently much stronger than any of the technical analysis you can do on any chart, because we are in unprecedented territory, or new waters. It was similar back in 2008 when we had the quantitative easing. No one knew what to expect and what's going to come, but we can expect some sharp and big volatility in the markets. And the problem with this stimulus package is that if the government starts to spend the fiscal stimulus package, it's going to take 6 to 9 months to see any effect in the economy, but the Fed is already in trouble because they have to follow and watch closely the economic indicators, and they have to intervene into the economy at the right time with the right tools and method, which is a really challenging thing to do. So all my respect to Jay Powell. So this was the video for this week. Remember guys, that do not risk anything more than 2 to 3% on each trade, and make sure you use proper risk management. If you have any questions, you can visit my website at alphafx.hu, or you can find the link to my public Telegram group in the description. You can also send a message in email or Telegram. If you like this video, make sure you hit the like button and subscribe to the channel. It would really help me to grow my account. And if you have any questions, message me. See you next week and stay safe.